Navigating the ethical horizon. The role of environmental, social, and governance (ESG) factors in investment decisions. In the evolving landscape of finance, the integration of environmental, social, and governance (ESG) factors has emerged as a transformative force, reshaping the way investors evaluate opportunities and risks. Beyond traditional financial metrics, ESG considerations have taken center stage, reflecting a broader recognition that sustainable, responsible, and ethical business practices contribute not only to long-term value creation but also to a more conscientious and equitable global economy. ESG metrics defined. Environmental factors encompass a company's impact on the planet, including its carbon footprint, resource usage, and environmental sustainability initiatives. Social factors delve into a company's relationships with its employees, communities, and broader societal impacts. Governance, the third pillar, evaluates the structures and processes that guide a company's decision-making. Addressing issues such as board composition, executive compensation, and adherence to ethical standards. Beyond profit. The ethical imperative. The incorporation of ESG factors into investment decisions goes beyond the traditional profit-driven paradigm. Recognizing that companies must be stewards of the environment, contributors to social well-being, and exemplars of transparent and accountable governance. Investors increasingly view ESG considerations as a fundamental aspect of risk management and value creation, aligning their portfolios with companies that not only deliver financial returns but also uphold ethical and sustainable business practices. Risk mitigation in the environmental realm. Environmental considerations have gained prominence as climate change and resource depletion pose existential threats. Investors recognize that companies vulnerable to environmental risks may face regulatory challenges, supply chain disruptions, or reputational damage. For instance, a manufacturing company heavily reliant on fossil fuels may encounter increased costs as carbon emissions regulations tighten. By factoring in environmental risks, investors can identify companies with sustainable practices, resilient supply chains, and proactive measures to mitigate climate-related challenges. Social impact as a barometer of corporate responsibility. Social factors provide a lens through which investors assess a company's commitment to its employees, customers, and the communities it serves. Companies fostering a positive workplace culture, prioritizing diversity and inclusion, and contributing to community development often exhibit resilience and long-term stability. Consider a tech company that actively promotes employee well-being, invests in education initiatives, and engages in philanthropy. Such practices not only enhance the company's reputation but also contribute to a more motivated and satisfied workforce, positively impacting long-term shareholder value. Governance is the bedrock of accountability. Governance considerations are the bedrock of ethical and transparent business practices. Investors scrutinize board structures, executive compensation, and adherence to ethical standards to gauge a company's commitment to responsible governance. Companies with robust governance practices are better equipped to navigate challenges, withstand crises, and foster a culture of accountability. For instance, a company with an independent board of directors and transparent executive compensation policies is likely to instill greater confidence among investors. The ESG advantage, a competitive edge. Companies embracing ESG principles are increasingly viewed as leaders in their respective industries. The integration of sustainability into business strategies not only aligns with global goals for a more sustainable future but also positions companies for long-term success. Investors recognize that businesses that proactively address ESG considerations are better equipped to changing market dynamics, attract top talent, and build resilient, future-proof operations. Measuring impact. ESG metrics and reporting, ***. The challenge lies in quantifying and comparing ESG factors across companies. Efforts to standardize ESG reporting have gained traction, with initiatives such as the Global Reporting Initiative, GRI, and the Sustainability Accounting Standards Board, SASB, providing frameworks for companies to disclose their ESG performance. Investors are increasingly relying on these metrics to evaluate the ESG performance of companies within their portfolios, allowing for more informed investment decisions aligned with ethical and sustainability objectives. ESG integration in investment strategies, ***. As the momentum for sustainable and responsible investing grows, asset managers and institutional investors are integrating ESG considerations into their investment strategies. ESG-focused funds, green bonds, and impact investing have become mainstream, offering investors the opportunity to align their financial goals with their values. The integration of ESG factors is not solely driven by altruism. Studies indicate a positive correlation between strong ESG performance and financial outperformance over the long term. Conclusion. Navigating the ethical horizon with ESG, ***. In the ever-evolving landscape of investment decisions, the role of ESG factors has transcended from a niche consideration to a mainstream imperative. Investors, recognizing the interconnectedness of financial performance and ethical business practices, are reshaping the financial ecosystem by demanding transparency, accountability, and sustainability. The integration of ESG factors in investment decisions is not merely a trend, it is a fundamental shift toward a more conscientious and sustainable approach to capitalism. As investors embark on this journey, the ethical imperative of ESG considerations illuminates a path toward a future where financial success converges harmoniously with environmental stewardship, social responsibility, and transparent governance.